How are tax returns chosen for audit? Hi, I'm Juliana, and I am an enrolled agent living in Texas, and I have a background at the IRS, as well as a master's in taxation. I like to talk about some of my experiences at the IRS, as well as some things you may encounter either in tax or with the IRS yourself. So if any of that interests you, then come along. Today, let's talk about how the IRS chooses tax returns to audit. Once upon a time when I audited, the IRS audited almost 2% or maybe a little over 2% of tax returns that are filed. And now, due to massive attrition, so people retiring, quitting, dying, all that stuff, and the hiring freezes, inability to hire good people and keep them on, the volume of audits has decreased significantly. I don't know what the current percentage is, but last I heard it was under 1%. But depending on how you fill out your tax return, your chances of being audited could increase significantly. Filing extensions do not increase your chances of being audited. The IRS looks for LUQ items, large, unusual, or questionable items. All tax returns, whether electronically filed or paper filed, do get input into the computer system, and then they are compared by a computer against other returns. They're also compared against all wage and income documents that are filed by other people, by third parties, to the IRS. That process could take a year, sometimes a little longer, to do, but the computers that compare the returns to each other, that can actually be a little faster. Any LUQ items on your return increase your numbers. Every return is given a diff score. I don't know what diff stands for, but that is a number. The higher the number, the more your return stands out. And they compare it to other returns that are likely to be in a similar situation to you. Married, self-employed in a certain industry, certain kind of income level, maybe. Sometimes you have a mortgage, you don't have a mortgage, you have certain dependents, live in a certain area of the country. They compare percentage of certain expenses to your income levels. Certain industries do not have a cost of goods sold, and so if they see that, it'll be unusual and questionable. If they see mileage for someone in a hairstylist industry, and that might be questionable as well. Some numbers will be large. A trucker and their mileage, that will definitely be large, or their gas receipts actually, because they can't use mileage, but that will be large. But it will also compare to other people in the industry. So they take each specific industry, they compare if you are self-employed or have rentals, they compare if it's a business return, other returns that are similar in the same industry. If you get a high enough diff score, and no, I have no idea what numbers constitute audit potential, then the return gets spit out to a department where for me at least, I could volunteer to do these audits, to choose returns which get to be audited, and I would be assigned a series of returns. I don't know how many, but it was a lot. And over the course of a week or so, every day, just from my desk, I would be assigned these returns in a different area. I don't remember if it was the same state or a different area of the country, so I had zero familiarity, zero bias, and I would look at the returns. I'd have a checklist, of course, and I'd go through certain things, see if there's anything that actually looked like it had audit potential. Any returns that look like they should be audited, we would mark down that they should be audited. Ones that don't, we'd have to write reasons why, what it seemed normal or reasonable, and then we would pass that information along. Our work would get then reviewed, and another determination would be made if we made good determinations. Any returns that would be audited would then move down to a more local group, and it's dependent on the address on the return. So not a POA address or anything like that. But if you've moved, then your audit could be assigned to somewhere where you aren't even actually living. So it's whatever address is on the return, whatever address the IRS has the latest for you, which is usually the return address. And then it gets assigned to an individual. And these are field audits, and I believe TCO office audits are the same way. And then the manager would assign it out to people in their group who then contact you via letter or phone in order to do your exam. I can't really speak to how correspondence audits are because I never was involved in any of that, but I assume that has to do with large, unusual, questionable items as well. And there's a much higher volume that get correspondence audits. Usually one, sometimes more items are picked and letters are sent out, sometimes from an individual and sometimes from a computer, to ask you questions and verify some items. That information will be reviewed by a person and a determination will be made based on your response. So don't be afraid that if you do something and put the expense on the wrong line, that you will automatically be flagged for an audit or something like that. Generally, people who have just straight W-2s, information that is also sent to the IRS, the computer system will just compare with what you put on the return, and if there's something that you missed, you'll just get an automatic computerized letter asking you about it. If you have a business, rentals, or something that's unusual, if you itemized, then you have a higher potential of being selected for an exam. So just doing something that you think might, because you don't understand it, doesn't necessarily make you higher risk. So if you have questions about if you might be higher risk, talk to your tax preparer, because they may know if doing a certain thing may or may not increase your audit potential.